In this video, Tom Lee of Fundstrat argues that the current market dip is a strong buying opportunity, noting that fundamental supports for stocks are still robust despite recent volatility. Tom also addresses the challenges facing small cap stocks, with Lee maintaining a positive long-term outlook despite investor frustrations. Additionally, Lee points out that the uptick in deal activity within the biotech sector as a promising sign, reinforcing his stance on investing during this dip as a path to future market recovery and growth.
I said, first of all, the neutral rate is much higher than what the Fed has indicated. I think it's between 3.5% and 4%. I also said long-term rates were going up. I've said that on your program several times, and I think they're going to go up more. And that's not necessarily an unhealthy development. Do you know that for the first time in almost 3 years, the 10-year is above the Fed funds rate? And that's a normal situation. I mean, we brought the Fed funds rate. Powell brought it down yesterday, 4.33%. And as you know, we're 4.5% now on the 10-year. It's normal for long-term interest rates to be above short-term interest rates. We were 3 years in an inverted term structure. That's not an unhealthy situation. So we are actually normalizing the interest rate structure. You could call it recalibrating if you wish.
Right.
But long rates, I think, have a way to go further up.
Well, if that's your sort of base case, how do you think about equities from here?
Well, it's more challenging in 2025 than 2024. But don't forget, one of the reasons why interest rates are going up and why the neutral rate is higher is stronger economic growth. I mean, Powell mentioned that many times in the news conference, that GDP growth has surprised on the upside. I mean, that's good for equities. It's bad for bonds, but it is good for equities. Now certainly, inflation has been more stubborn than expected. I still think there's, as he mentioned, some rental lags that I think are going to help us in 2025 get it closer to that 2%. But, higher interest rates don't necessarily mean a bad situation when they're caused by rises in productivity or rises in real GDP. And that's certainly one of the causes of the rise in the long-term rates.
But then do you look at yesterday or today and say this is a dip? Here's an opportunity, or do you say there's going to be a bigger dip?
Well, I thought there was a lot of trend followers, a lot of momentum players. I mean, they were on the train running up Tesla, many of the other Mag 7. That's not a healthy situation. All it takes is a little negative knock, and whoop, they jump off the train. And I prefer to see a market more dominated by fundamentals than momentum players that are just taking the ride. So I actually think market's certainly healthier today than it has been for the last few weeks, where we saw a lot of momentum players.
How do you estimate, factor in, bet on what happens in 2025 to the economy, to the equity market, in the context of the tariff conversation we've been having all morning, in the context of whatever you think tax policy is going to look like?
Yeah, I think that the tariff is the biggest question. And the immigration question are both big questions that are facing the market. But there's a lot of positive features. However, I don't think we're going to match the gains of 23. 24, I'm really thinking of 0 to 10% probably overall. I wouldn't be surprised to see finally value stocks break up more on the upside, and maybe the Mag 7 taking a rest from an incredible run. I don't think it's any sort of bubble on the Mag 7, but certainly to keep up 40, 50% gains is something that would be extremely against the odds for next year. So a bit of rotation, a quieter stock market, but still positive for investors.